let's talk about the 3 top price action, technical analysis, whatever you want to call it, but we call it price action patterns that you can see for very reliable trading on a little bit higher time frame. So we're going to talk about flags, pennants, and wedges. They are very distinctly different, and they also provide different sorts of trading opportunities, but all 3 of them are high probability. They're high probability because they're so visual that a lot of people can see them on their charts. They're so high probability because of the psychology of the way that these 3 patterns develop. So let's start with flags. So if you're trading a flag pattern, you have to properly identify it. Identify the top of the flag first. So it's assuming we're trading it long. You're going to look for 1, 2 distinct tests on the top of a flag. Let's talk about the bottom of a flag. 1, 2, ideally 3 distinct tests on the bottom of the flag. Let's talk about the starting point of the flag. It should be a really clear, distinct point, and then the other one should also be a clear, distinct point. Flags do not necessarily come to a point. Those tend to be more pennants or wedges. Flags are kind of an upward or slightly downward sloping channel. The way to trade those is wait for the channel breakout to occur. Your stop is actually at the low of the opposite side of the channel. These are very, very good for second chance scalps. And you can sort of see a lot of times they will occur on an increase in volume as well. Pennants have very distinct, with a pennant you start at the lows actually. So price comes up and you look at where the lows are connected. The lows should be very distinctly flat. It is a defined amount of buyers or demand at a specific level. You should very easily be able to connect those lows, and it should be flat. You're looking again for 3 tests at least of the lows, and ideally 2 tests of the highs. So you want 1 less test of the highs than of the lows. So we have our defined low. Then you go to the point where it starts. It should be very, very, very clear. It should be very distinct and very clear. This is a great observational top of a potential pennant if that was to be a pennant. It just stands out from everything else. The highs should connect to that downsloping line and be easily connectable. The way you're going to trade a pennant breakout is you're going to trade and buy above the high of the trend line. The best ones will occur on really strong volume. But this pattern, unlike a flag, tends to lead more towards momentum building than a big, strong break right from there. So what you're thinking of on this is you're going to have to move your shot clock out a little bit because it's likely that the downtrend has now potentially turned into an uptrend. So you don't want to have extreme expectations. You just want to see it start to make higher lows and higher highs all the way through. If it has a lot of volume, it's really going to accelerate to the upside, but don't let that be your expectation. Think about it as a move that's going to continue to build to the upside. The third and final very visual high probability pattern, which is one that you'll see more traders like on the desk than probably the other 2, is a very distinct wedge pattern. And a wedge pattern encompasses way more volatility than the other 2, which is what we really, really like about it. It also has far more of a directional focus because if it breaks in either direction, you can expect it to be a fast, powerful, sustained move. You identify it by looking for, start with the bottom, look for an easily connectable, usually again, 3 mini points there that are easily connectable and upsloping. On the top, you want at least 2, maybe 3, but ideally 1 less than however many points are at the bottom. And again, you want that to be downsloping. You want there to be a good amount of volatility. For this, you want the angle to be somewhere between 15 and maybe 45 degrees. sometimes even a little bit more than that. But you want it to come to a concrete point, and you want to see the volatility compress as the move continues to build out. And then you're looking for an abrupt, aggressive volatility expansion out of this. Paired with high volume, that's the best version of it. And you're looking for a fast move initially. Puts you in the money very fast. You're buying above the high of the downtrend, the break of the downtrend line. Your stop is below the downtrend line, right? So it's kind of a weird moving stop with it. You're expecting to be in the money quickly on high volume. If it pulls back, you're expecting the pullback to be less than 1/2 of the initial move. You can kind of cheat it once it kind of starts to go up and use that as a mental stop. But then you're looking for continuation to the upside. This is usually a 2-leg move when you get it. But those three are very clear, very distinct, very simple because they're so visual. Price action patterns that you could just practice drawing on your charts all day and observe how the price action plays out each time.